History remembers the autumn of 1929 as a sudden, catastrophic act of financial violence. It is often painted as a storm that came out of nowhere, leveling the playing field and devastating the American dream in one fell swoop. But to understand the true anatomy of the Great Crash and the immense fortunes that were forged in its immediate aftermath, we must first understand the psychology of the 1%. We must understand that for the true elite, a market crash is never a surprise. It is a highly anticipated transfer of wealth. This is the parable of dumb money versus smart money. This is the story of how panic is manufactured, harnessed, and ultimately used to acquire generational wealth. To set the stage, we must step back into the roaring heart of the 1920s. The First World War was in the rearview mirror. Industrial production was exploding, and a dangerous new narcotic had been introduced to the American public: easy credit. For the first time in history, the average citizen could buy stocks on margin. You didn't need the full price of a share, you only needed 10%. The banks would happily float you the rest. This structural leverage created an intoxicating environment of unbridled optimism. The stock market transformed from a quiet, calculated arena for serious capital allocators into a noisy, neon-lit casino for the masses. School teachers, factory workers, and taxi drivers were throwing their life savings into radio and utility stocks, watching their paper wealth multiply overnight. The prevailing psychology was simple and deadly. The market goes in only one direction, and to sit on the sidelines is to be a fool. This is the defining characteristic of dumb money. It is capital driven purely by emotion, by the fear of missing out, and by a fundamental misunderstanding of value. Dumb money buys the top because everyone else is doing it. But watching silently from the gilded balconies of Wall Street were the financial elite. Men like Joseph P. Kennedy. Kennedy was a ruthless, brilliant speculator who understood that markets are not driven by mathematics, but by human psychology. The smart money operates on a completely different emotional frequency. Where the public feels greed, the elite feel a creeping sense of caution. They know that when asset prices completely detach from their underlying earnings, gravity is inevitable. The legend goes that in the winter of 1928, Joseph Kennedy stopped to get his shoes shined in the financial district. As the boy polished Kennedy's Oxfords, he looked up and offered the wealthy titan a stock tip. He told Kennedy which railroad stocks were poised to surge. Kennedy nodded, tipped the boy, and walked away with a chilling realization. If a Shoeshine Boy, someone completely disconnected from the fundamentals of corporate finance, was giving stock tips to a millionaire, then the pool of fools was completely empty. Every last drop of dumb money had been poured into the market. There was no one left to buy. The psychology of the 1% dictates a ruthless, contrarian discipline. It requires the emotional fortitude to walk away from the table while the party is still roaring. Following that encounter, Kennedy went back to his office and began systematically liquidating his entire stock portfolio. But he didn't just sell, he took it a step further. He began to short the market. He bet heavily against the very companies the public was furiously buying. He was willing to look foolish in the short term, missing out on the final, frenzied months of the bull run, because he understood the architecture of the coming collapse. The smart money was quietly moving to the exits, hoarding cash and preparing for the slaughter. They were setting the trap. The music stopped in late October 1929. The initial cracks appeared on Black Thursday, a sudden, terrifying drop in prices that sent a shiver down the spine of the nation. But it was Black Tuesday, October 29th, that broke the back of the American economy. The mechanics of the crash were mathematically precise and brutally unforgiving. Remember the easy credit? The margin loans? As soon as stock prices dipped, brokers began issuing margin calls. They demanded that investors deposit more cash to cover their plummeting portfolios. But the public didn't have cash. They only had the stocks. So, to meet the margin calls, they were forced to sell. This forced selling drove prices down further, which triggered even more margin calls, creating a devastating, self-fulfilling spiral of liquidation. This is where the psychology of panic is weaponized. Dumb money operates on a spectrum between two extremes: absolute euphoria and absolute terror. When the euphoria cracks, the transition to terror is instantaneous. In the span of a few hours, the trading floor of the New York Stock Exchange descended into primal, animalistic hysteria. Men were screaming, weeping, and tearing at their collars. Blue-chip companies, the titans of American industry, were offered at fractions of their previous day's value, and yet there were no buyers. The ticker tape ran hours behind, leaving millions of Americans completely blind to exactly how ruined they were until the evening papers hit the stands. It was an evaporation of paper wealth so staggering that it fundamentally rewired the collective psyche of a generation. But where was the smart money during this apocalypse? They were not on the trading floor. They were insulated, calm, and highly liquid. Joseph Kennedy, Bernard Baruch, and a handful of other elite financiers were watching the chaos unfold exactly as they had modeled it. The psychology of the 1% during a crash is marked by a complete absence of panic. While the middle class was watching their life savings turn to ash, the elite were coldly calculating intrinsic value. They understood that a company's actual worth, its factories, its patents, its cash flows, did not disappear simply because the stock price collapsed. The market was indiscriminately punishing both the worthless speculative shell companies and the fundamentally sound titans of industry. Panic is blind. It forces the liquidation of good assets alongside the bad. This creates a highly asymmetrical environment. When the public is forced to sell everything just to survive, the price of world-class assets drops dramatically below their true value. For the smart money, a crash is not a tragedy. It is the ultimate clearance sale. It is a rare, generational window where the laws of supply and demand are temporarily broken by sheer human terror. The elite recognize that panic is merely the violent expulsion of leverage from the system. Once the leverage is gone, and the weak hands have been thoroughly washed out, the floor is established. The dumb money has been entirely eradicated, left with nothing but margin debt and bitter regret. The stage is now perfectly set for the final phase of the cycle, the Great Accumulation. The transfer of wealth from the impatient many to the patient few was about to begin. The aftermath of a crash is a landscape of profound desolation. The roaring Twenties gave way to the quiet, crushing despair of the Great Depression. The public, completely traumatized by the market, vowed never to touch stocks again. The concept of investing was viewed with deep suspicion, akin to outright gambling. Cash was hoarded under mattresses. Real estate was abandoned. Businesses were shuttered. The dumb money had learned a painful lesson and retreated entirely, driven by the lingering psychology of fear. But it is precisely in this environment of maximum pessimism that the 1% execute their most brilliant and ruthless maneuvers. While the masses were focused on daily survival, the smart money went shopping. Joseph Kennedy, sitting on a mountain of cash generated from his brilliant short positions, began to acquire assets for pennies on the dollar. He purchased massive swaths of commercial real estate in Manhattan and Chicago. He bought the rights to Hollywood studios. He acquired vast stakes in solid, dividend-paying corporations that had been unfairly battered by the panic. He understood the golden rule of elite capital. You buy when there is blood in the streets, even if some of that blood is your own. The psychology of the elite allows them to separate the economic reality from the prevailing social mood. They knew that America would eventually recover, that industry would churn again, and that these assets would return to their historical valuations. This is the hidden mechanism of generational wealth. It is rarely built during the euphoric peaks of a bull market. The wealth of the 1% is consolidated in the trenches of a depression. By acquiring premium assets at deep discounts, the elite ensure that when the economic cycle inevitably turns, when the credit thaws and the public slowly regains its confidence, their capital will compound at exponential rates. When the market eventually recovered in the decades that followed, the assets purchased by men like Kennedy in the 1930s exploded in value. It established the Kennedy family as an American political and financial dynasty, providing the limitless war chest that would eventually put his son in the White House. The parable of 1929 is not a dusty relic of history. It is a permanent blueprint of human financial behavior. The exact same psychological cycle plays out in every generation. We saw it in the dot-com bubble, we saw it in the 2008 financial crisis, and we will see it again. The technology changes, the specific assets change, but the raw human emotions of greed and fear remain constant. The dumb money will always arrive late to the party, driven by the seductive illusion of easy wealth. They will borrow money they don't have to buy assets they don't understand. And when the music stops, they will panic and sell at the absolute bottom. The smart money, meanwhile, will always be waiting. They will maintain their discipline, preserve their liquidity, and watch the hysteria with cold, calculating eyes. They will allow the public to bid prices up to the stratosphere, happily selling them their shares at the peak. And when the inevitable crash comes, they will step into the wreckage, checkbook in hand, ready to buy the world back at a fraction of the cost. This is the brutal, undeniable truth of the financial ecosystem. Wealth is never truly destroyed in a crash. It is merely transferred. And as long as human nature remains unchanged, the psychology of the 1% will ensure that the transfer always flows in one direction.